Enron was once a shining star in the business world. With a market capitalization of over $60 billion, it was the envy of Wall Street. But in 2001, everything changed. Enron filed for bankruptcy in one of the biggest corporate scandals in history. At the heart of the scandal was the company's massive debt. Enron tried to conceal it with the help of special economic entities and special purpose vehicles. But when the truth came out, the company's fortune took a dramatic turn for the worse. The failure and bankruptcy of the Enron Corporation jolted Wall Street and left many employees on the brink of a financial crisis. Enron had traded at an all-time high of $90.75 per share on December 2, 2001. But when the accounting scandal emerged, stock prices plummeted to a record low of just 26 cents per share. In this video, we'll take a closer look at the Enron scandal, exploring how it happened and what lessons we can learn from it. We'll examine the key players and events that led to Enron's downfall and explore the impact of the scandal on the wider business world. From the dangers of unchecked corporate greed to the importance of transparency and accountability, there are many lessons to be learned from Enron's rise and fall. So join us as we delve into the story of one of the biggest corporate scandals in history and discover the lessons we can all learn from it. Enron Corporation was founded in 1985 as a result of a merger between two natural gas pipeline companies, Houston Natural Gas and Internorth. The newly formed Enron was headquartered in Houston, Texas, and initially focused on the transportation and distribution of natural gas. However, Enron's management team had ambitious plans to transform the company into a global energy powerhouse. They believed that by branching out into new areas such as electricity trading and broadband services, they could create a highly profitable and diversified business. Over the next decade, Enron expanded rapidly, using innovative financial instruments and accounting techniques to boost its profits and disguise its debts. The company became a darling of Wall Street, with a soaring stock price and a reputation for being one of the most innovative and dynamic companies in the world. On August 1, 1990, Jeffrey Skilling took on the role of chairman and chief executive of Enron Finance, a subsidiary of Enron Corporation. Skilling was a former consultant with McKinsey & Company, and he brought a new vision for Enron's future. Under his leadership, Enron began to focus on high-risk, high-reward ventures in the energy industry, such as energy trading and power generation. Skilling's aggressive management style and focus on financial engineering played a significant role in Enron's eventual downfall. On January 30, 1992, the U.S. Securities and Exchange Commission (SEC) allowed Enron to use mark-to-market accounting, a controversial accounting method that allowed the company to record anticipated profits immediately, instead of waiting for the actual delivery of goods or services. This new accounting system gave Enron the ability to report fast-growing profits, leading to a surge in the company's stock price and increasing investor confidence. However, the use of mark-to-market accounting also created significant risks and allowed Enron to manipulate its financial statements. Ultimately, the use of this accounting method played a significant role in the company's downfall. In 1992, Enron took a bold step and shifted its focus from being a natural gas distributor to a natural gas marketer. Through aggressive marketing and strategic partnerships, Enron became the largest seller of natural gas in North America. This transformation allowed Enron to capture a larger share of the value chain and increase its profitability. Enron's success in the natural gas market set the stage for the company's later expansion into other energy markets and its eventual downfall. On December 31, 2000, Enron's stock price closed the year at $83.13, an increase of 87% from the previous year. The company's market capitalization exceeded $60 billion, and Enron was considered the most innovative large company in the United States by Fortune magazine. Enron's success was attributed to its aggressive expansion into new markets and its use of complex financial instruments, which allowed the company to report large profits. However, behind the scenes, Enron was engaging in fraudulent accounting practices and hiding its debts, which would eventually lead to its downfall. On October 22, 2001, the Enron board of directors received some shocking news. They learned that the company's chief financial officer, Andrew Fastow, had received $30 million from managing the LJM partnerships. The partnerships were set up by Fastow himself, and they were used to hide Enron's losses and debts from investors. This news, coupled with the SEC's announcement that it would investigate several Enron deals, caused the company's stock to drop 20% in a single day. 2 days later, on October 24, 2001, Enron fired Andy Fastow, hoping to distance itself from the scandal. However, this did little to alleviate the company's mounting financial problems. On October 30, 2001, credit rating agencies lowered Enron's credit rating. The agencies cited concerns about Enron's accounting practices and its heavy debt load. Meanwhile, from August through the end of October, Enron's CEO, Ken Lay, had sold 918,000 shares of Enron while insisting to others that the company was in good financial shape. In November 2001, in a desperate effort to save itself from bankruptcy, Enron explored merger or acquisition possibilities with its rival, Dynegy. However, these talks ultimately failed to materialize. Enron's mounting debt and fraudulent accounting practices made it an unattractive prospect for any potential buyers. On November 28, 2001, Dynegy announced that it would not acquire Enron, and Enron's credit rating was reduced to junk status. This made it extremely difficult for Enron to secure financing or attract investors. Enron's stock price fell to a mere 61 cents, a far cry from its high of $90.75 just a year earlier. Finally, on December 2, 2001, Enron filed for Chapter 11 bankruptcy protection, marking the end of one of the biggest corporate scandals in history. The company's fraudulent accounting practices and reckless pursuit of profits had ultimately led to its downfall. Enron's collapse had far-reaching consequences, causing thousands of employees to lose their jobs and shaking investor confidence in the entire financial system. As we've seen in this video, the Enron scandal had far-reaching consequences for its executives and employees. The fallout continued long after the company's bankruptcy filing. In July 2006, former Enron CEO Ken Lay was staying in a cabin outside Aspen, Colorado, with his wife when he suffered a heart attack and passed away. Andy Fastow, the former chief financial officer of Enron, was sentenced to 6 years in prison on September 26, 2006, for his role in the company's accounting fraud. His cooperation with prosecutors was a key factor in the conviction of other executives, including Lay and Skilling. Speaking of Skilling, he was sentenced to 24 years in prison and fined $45 million on October 23, 2006, for his involvement in the scandal. His sentence was the longest for any Enron executive, and his conviction was seen as a victory for the government's efforts to hold corporate executives accountable for their actions. Finally, on December 13, 2006, Jeff Skilling began serving his sentence at a low-security prison in Waseca, Minnesota. The scandal had come to a close, but its impact continued to be felt by those involved and by the wider business community. The Enron scandal serves as a cautionary tale of what can happen when corporate greed and unethical practices go unchecked, and it remains a stark reminder of the importance of transparency and accountability in the business world.